Price pushes up. But the trade cannot stay simple. The session forms inside extended memory. May 3rd Asia session forms between May 1st U.S. session midpoint and May 1st U.S. session 150% area. It does not form in open space. It forms inside extension. It overlaps old pressure. It starts above recent memory. That matters. When a session forms between a midpoint and an extension area, price is already under pressure. It can continue higher. It can also snap back fast. So the first rule stays the same. Do not chase the first push. Wait for the boundary. Wait for holding. Wait for price to show where it cannot stay. May 3rd Asia session first moves lower. It reaches May 1st U.S. session midpoint. It tests. It reacts. It cannot stay weak. That test matters. If sellers had control, price should hold below that midpoint. It should create distance. It should keep pulling down. But it does not. The reaction comes back. The drop loses pressure. The lower test becomes the first warning. Then, price turns up. It breaks above May 1st U.S. session upper boundary. Now the move is stronger, but it still needs proof. Price must stay above the broken boundary. It must not return immediately. It must build distance. It pushes again. It breaks above May 3rd Asia session upper boundary. Now the session is no longer trapped inside the box. The move starts to extend. But extension creates a new problem. Every higher target becomes more sensitive. Every pullback matters more. Every reaction can end the move. Price continues upward. It reaches May 3rd Asia session 200% area. That area is important. It sits near the weekly 0.5 area. So the move is not only reaching a session extension, it is reaching larger time frame pressure. That changes everything. A trader cannot treat that area as ordinary continuation. Price reaches the 200% area. It touches. It reacts. It has to prove holding. If it stays above, continuation can continue. If it cannot stay, the long may be finished. Now go back to the first long. The long setup starts earlier. Long entry line. April 30th Asia session lower boundary. Stop loss line. April 27th U.S. session midpoint. Take profit line. May 3rd Asia session upper boundary. The entry is not at the top. The entry is not after the breakout. The entry comes from lower memory. April 30th Asia lower boundary becomes the long entry line, because price had to hold lower structure first. If price could not hold there, there was no long. If price held there and moved away, the long could build. That is the difference. A late buyer sees the breakout. A structured trader waits for the lower boundary to hold first. The stop sits at April 27th U.S. session midpoint. There is a closer option. Some traders may use April 27th U.S. session upper boundary. That gives a better looking risk-reward. It looks cleaner. It feels more efficient. But May 3rd Asia session shows hourly movement with enough pressure to make that stop risky. Price can dip. Price can test old upper memory. Price can touch the tighter stop. Then it can continue higher. The trade idea may still be alive, but the position is already gone. So the safer stop sits deeper. April 27th U.S. session midpoint. At minimum, the stop needs to sit below that area. Why? Because if price reaches April 27th U.S. session midpoint, the lower memory has weakened much more. The long no longer has clean control. That becomes real damage. Not noise, not discomfort. Real failure. The first target sits at May 3rd Asia session upper boundary. That is the first place where the new session must prove itself. If price reaches the upper boundary and cannot hold above, the long has paid. If it holds and moves away, the trail can begin. Now price does move away. It breaks above the upper boundary. The trade earns distance. So trailing becomes possible. First trailing target. May 3rd Asia session 150% area. Price already left the original target. It has earned a larger objective. But the target cannot move alone. The stop must follow. If the stop stays too far behind, the trail becomes hope. If the stop moves too tight, normal reaction removes the trade. So the stop must follow structure, not emotion. Price moves again. Second trailing target. May 3rd, Asia session 200% area. This area matters more. It is also near the weekly 0.5 area. Risk-reward ratio, 2.31. That is where the long must be treated carefully. The market has reached session extension. It has reached higher time frame pressure. It has traveled far enough. You do not assume it will continue. You watch the reaction. Price reaches the 200% area. It does not create clean distance right away. Reaction starts to matter. The long has already paid. The second trail has done its job. Now the same level can become the next trade. After the second trailing take profit, the 200% area becomes a short entry candidate. Short entry line. May 3rd Asia session 200% area. Stop loss line. May 3rd Asia session 300% area. Take profit line. May 3rd Asia session upper boundary. First trailing target. May 3rd Asia session midpoint. Second trailing target. May 3rd Asia session lower boundary. Risk-reward ratio, 2.02. The short does not start because price is high. It starts because price reaches the 200% extension, near weekly 0.5, and cannot stay cleanly above it. That is the key. The long ends there because the move reached pressure. The short can start there because the same pressure blocks continuation. One level. Two decisions. First, it pays the long. Then it can trigger the short. But only if behavior changes. Price reaches. It fails to hold. It reacts back. Then the short becomes possible. The stop sits at May 3rd Asia session 300% area. If price reaches 300%, the 200% failure has failed. The market has expanded again. The short no longer has control. You leave there. The first target sits at May 3rd Asia session upper boundary. That is where the extension began. If extension fails, price often returns to its own box. That first return is enough. Then, if price keeps moving lower, the trail can press toward the midpoint, then toward the lower boundary. But again, target cannot move alone. The stop must follow. A short that trails too tight can get stopped by normal reaction. A short that trails without protecting profit does not really trail. It just hopes for more. So the same rule holds. Trail only after price earns distance. Move the stop with the target. Protect profit. Do not suffocate the trade. Now the full May 3rd structure is clear. Price tests. May 1st US midpoint. It cannot stay weak. It breaks. May 1st US upper boundary. It breaks. May 3rd Asia upper boundary. It reaches May 3rd Asia 200% area near weekly 0.5. The long completes there. The short can start there. Not because opinion changed. Because behavior changed. Long works when lower memory holds. Short works when upper extension fails. Entry changes. Stop changes. Target changes. But the rule stays the same. Price reaches. It reacts. It holds or fails. Then you execute. Price compresses. But the candle warns. The next session forms inside repeated memory. May 4th U.S. session forms between May 3rd Asia session midpoint and May 3rd Asia session lower boundary. It compresses by about 50%. It overlaps there. It also forms between May 1st U.S. session upper boundary and May 1st U.S. session midpoint. That is another 50% compression. So the session is not sitting in empty space. It is compressed between two memories. May 3rd Asia memory. May 1st U.S. memory. That matters. Repeated compression deserves attention. When a new U.S. session forms inside the prior Asia structure, and also inside the May 1st U.S. box, the market is preparing a decision. But attention is not entry. The session still has to prove direction. Now look at the basis candle. May 4th U.S. session basis candle is a Doji candle. That matters. A Doji at compressed memory shows hesitation. Price opens the fight. It cannot decide immediately. It tests. It returns. It leaves uncertainty behind. So the first reaction after the Doji becomes important. Price starts to lift. It breaks above May 4th U.S. session upper boundary. That first break matters. But a break alone is not enough. Price must stay above. It must create distance. It must not fall back inside the Doji range. Then price continues. It breaks above May 3rd Asia session upper boundary. Now the long setup becomes active. Long entry line. May 3rd Asia session upper boundary. Stop loss line. May 4th U.S. session lower boundary. Take profit line. May 3rd Asia session 200% area. The entry sits at May 3rd Asia session upper boundary. Why there? Because May 4th U.S. session first forms compressed below that level. Then price breaks above its own upper boundary. Then it reaches the May 3rd Asia upper boundary. If price can reclaim that line, the move is no longer stuck inside lower compression. The upper boundary becomes the decision line. If price holds above it, buyers can continue. If price returns below it, the breakout loses control. That is where the long begins. Not inside the Doji, not inside the compressed middle. At the reclaimed upper boundary. Now the stop. In principle, a wider stop can be considered. Looking at the earlier May 4th U.S. hourly flow, a safer structural stop could sit at least near April 27th U.S. session upper boundary. That gives more room. It avoids noise. It protects against a deeper retest. But the chart gives another clue. There is a large bullish candle before the continuation. That candle changes the risk. When a strong candle expands away from the compressed area, a full return to the tail area becomes harder. Not impossible, but harder. If price gives back the entire large candle and reaches back into the deep lower area, the breakout has already lost strong control. So in this case, May 4th U.S. session lower boundary can be enough as the stop line. It is still below the session structure. It still protects the trade. It is not placed inside the middle. It gives the trade room without making the risk too heavy. That is why the stop can sit at May 4th U.S. session lower boundary. The target sits at May 3rd Asia Session 200% area. Why there? Because May 3rd already showed that the 200% area matters. It is near weekly 0.5. It already acted as a major pressure zone. If May 4th US long moves upward, the first serious objective is not random. It is that 200% area. Price reaches it. It tests. The trade has paid. If price holds above it, the next trail can begin. First trailing target. May 3rd Asia Session 250% area. Price must earn that trail. It must hold above the 200% area. It must not return fast. It must create new distance. Then the trail can move. Second trailing target. May 3rd Asia Session 300% area. That is a larger extension. It cannot be assumed. It must be earned. If price starts to stall near 250%, you do not force 300%. If price moves away cleanly, the trade can press. But once again, the stop must move with the target. Do not repeat the mistake. A bigger target with the same old stop is only greed. The stop has to follow the latest structure. It must protect what the market already paid. But it cannot be too tight. If it sits too close under the current candle, a normal pullback ends the trade. If it stays too far below entry, the trail does not protect anything. So the trail must do one job: protect earned distance. If it does not do that, do not trail. Now watch the full May 4th sequence. May 4th US session forms compressed between May 3rd Asia midpoint and lower boundary. It also overlaps between May 1st US upper boundary and midpoint. The basis candle is a doji. The market hesitates. Then price breaks above May 4th US upper boundary. It breaks above May 3rd Asia upper boundary. It breaks above May 3rd Asia 200% area. It tries to reach May 3rd Asia 250% area. The long comes from reclaiming upper memory, not from chasing the candle, not from guessing continuation. The entry is May 3rd Asia upper boundary. The stop is May 4th US lower boundary. The first target is May 3rd Asia 200% area. The trail can reach 250%, then 300%, but only after price proves distance. Now connect the two setups. The earlier structure gave a long into May 3rd Asia 200%. Then the same 200% area became a short candidate when price could not stay above. The next structure gave another long after May 4th. US compression broke upward. The market did not give one opinion. It gave decisions. Lower memory held. Long. Upper extension failed. Short. Compressed doji broke upward. Long again. That is real execution. The chart does not care whether you want to be bullish or bearish. It only shows where price can stay. If price holds above upper memory, longs can continue. If price fails at extension, shorts can form. If price compresses inside old memory, you wait for the edge. If the edge breaks and holds, the trade begins. Everything returns to the same rule. Price reaches. It reacts. It holds or fails. Then you act. The next trade does not begin because price moves. It begins when structure gives the line.